Hey guys, so today I want to talk about deal structuring, but I want to talk about deal structuring for lower middle market companies, right? Small, medium size enterprises. And we want to talk about lower middle market deals between 1 to 5 million in price. And I have 10 points for you of, when it comes to structuring deals, what to take into account. All right, let's get started. So the number one point is valuation method. Now, I've seen a lot of people that do small deals and they bring on a very high level investment banker or a M&A advisor or M&A director, right? That's not something that you need. And oftentimes these guys, they're used to dealing with big deals, 500 million, billion-dollar deals. And those deals they're not gonna have the same metrics as a small 1 million to $5 million deal, because these smaller companies, cash flow is very important. But when you have these larger enterprise companies, 100 million, $500 million company, they have a very, very diversified stream of revenue. So they could be a little bit more, lax on the metrics that's being used. And a lot of these guys, they use EBITDA. Now, EBITDA is a favorite valuation metric that is from high level investment bankers all the way down to, brokers, business brokers. Now, I am vehemently against using EBITDA to value businesses between 1 to 5 million because it leaves out a lot. It doesn't take into account the structure of the business, the lifestyle of the seller, what kind of organizational structure that the business has. There's a lot of things that EBITDA leaves out, and I'll do a video, of why specifically I don't like EBITDA and the pros and cons, more so the cons of it. But this is not the video for that. But that's just some of the things that it doesn't take into account when you're talking about, using the metrics such as EBITDA to value small businesses between 1 to 5 million when cash flow is extremely important to these small businesses, right? Okay, so point 2, purchase price allocation, right? So a lot of times, you want to have tangible assets and there's intangible assets, and then you're going to have liabilities that's involved, right? So how are you allocating the capital? The purchasing capital for that business, and allocating the capital the right way and having adequate working capital after the deal is closed is what's going to allow you to succeed and have your post acquisition, your integrations, everything is going to come smoothly. But you have to be careful of how you allocate that capital, and you want to make sure that you're paying the right people. And especially when it comes to the closing costs, you don't want to have an inflated cost because you're using high-level firms and all these third-party services that you really don't need. So you want to make sure that the capital allocation is very, very tight. And you want to make sure that you have a financial professional that knows exactly what they're doing when it comes to that, that purchase price allocation. Now, payment structure. A lot of times, a lot of people, they want to structure deals where the seller, they get something up front, but they hold something back. But when you're talking about dealing with larger companies, it's easier to pull off. But when you're talking about 1 to 5 million dollar companies, it's a little bit more difficult because that's something that someone's been working for about 20 years or so, 10, 15, 20 years. And you telling them that you want to hold any portion of that payment back is actually, is going to be met with a lot of pushback because that seller is looking for the most amount to cash out, because they still have to pay capital gains tax and some other taxes. So they're trying to get the most, and they don't have that much wiggle room to be able to negotiate, as opposed to, a $500 million or a $100 million deal where the seller tends to be a little bit more investor savvy, investor minded, if that makes sense. So the structure, how you're going to pay the seller, makes all the difference. Typically, we like to, there are different structures that we present the seller. And the way that we phrase it is, hey, we know that you have concerns about capital gains tax. We have a couple ways of alleviating that. And one of the ways is for you to hold a note. Now, depending on the amount of the deal, and what kind of business it is, you may hold back a certain percentage. Now, I like to hold back minimum 30%, and that's kind of like a risk minimizing thing for us in doing so. So you may want to, look at the same thing, but there are other structures that you can entertain instead of doing a seller finance. You could do an earnout. We like to do earnouts based on, defined EBITDA targets, and that's something that you would have to discuss. But we simply like to say, hey, at the end of the year, depending on the performance of the company, following year, if it doesn't perform, the same weight that it did the previous